A topic that I often hear mentioned in the industry that's rarely fully understood by most people, even financial planners and advisors, is understanding how tax brackets actually work. I will sometimes hear a couple say, we get absolutely killed in taxes. We make 500 grand a year and we're in the 35% tax bracket. When this is said, most people assume that, gosh, if they're in a 35% tax bracket, that means they're paying 35% of 500 grand or $175,000 in taxes each year. That would certainly be a very high tax rate if this were actually the case, but this is absolutely not how the US tax code works in reality. In reality, a couple with $500,000 of taxable income would have paid an average rate of only 23%, or about 1/3 lower than how it appears on the surface. Let's look under the hood and see how this actually works in real life. We'll use the 2024 tax brackets for a married couple. Imagine this couple has $529,200 in gross ordinary income. After we subtract the 2024 standard deduction of $29,200, their taxable income is 500 grand. We're going to keep it simple using the standard deduction for now, and later we'll cover in a separate video the difference between the standard deduction and itemized deductions. With 500 grand of taxable income, this couple is in fact, yes, in the 35% tax bracket. Now, all this means that they earn $1 more of income, that extra dollar would be taxed at 35%. However, only $12,550 of their income is actually taxed at 35%. Think of it like filling up buckets with water. You fill the lower tax brackets first before spilling into the higher ones. This way, only a small portion of their income is taxed at the highest rate, which affects how much they owe in taxes. Here's how the taxes break down for $500,000 of taxable income. The first 23 grand is taxed at 10%, the next 71,000 taxed at 12%, the next 107,000 taxed at 22%, the next 183,000 taxed at 24%, the next 104,000 taxed at 32%, and only the final 12,550 is taxed at 35%. This results in a federal tax bill of $115,250, which is much less than $175,000 if the entire amount were taxed at 35%. So for 500 grand of taxable income, the effective tax rate is 23%. Now, our Director of Tax, Chris Smith, points out marginal tax rates are crucial for short-term year-over-year tax planning decisions, but effective tax rates are more impactful for long-term planning decisions. We like to say, over the long term, we'd rather be directionally right than precisely wrong. Of course, the US tax code is about as clear as mud. While this could be obvious to some viewers, we find that many clients appreciate how remarkably low current income tax rates are on high-income individuals. At Brandywine Oak, we obsessively review every client's current and future income tax situation to help them keep more of their hard-earned life savings. Don't let tax myths cloud your judgment. Contact us today to get a clear picture of your tax obligations and learn how you can optimize your tax strategy. Scan the QR code to schedule a consultation to see how we might be able to help.